Well, today we're going to look at, in this part 2 of our accounting review, the balance sheet. In abbreviation, the balance sheet is simply a mathematical relationship to show how total assets equal total liabilities plus stockholder equity. The left side of the balance sheet, the asset side, lists what the company has. The right side of the balance sheet shows what the company owes regarding that. Total liabilities owing the banks or the vendors, and stockholder equity owing the stockholders who have invested in the firm. So with this fundamental picture of the balance sheet, let's take a look at some of the components. Under the asset side, we have current assets and fixed assets. Current assets, assets that have to be that can generate cash in the near term, and fixed assets, things that, well, a little more substantial, such as the factory or the building. Sometimes other assets will be listed that don't cleanly fall into the current or fixed asset side, but that would be the under the purview of the accountant's rules. But we're going to mostly concern ourselves with current and fixed assets. This adds together to give us total assets. Under the liability side, we have current liabilities, and then we have long-term liabilities. Current liabilities, money that is owed in the near term. Long-term liabilities, money that is owed over a longer term. This gives us our total liabilities. And then we have equity, which is both the preferred and common stockholder aspects, plus we have retained earnings. Retained earnings being the element of the value of the business that is still owed to the common stockholders, but has been kept back, as we saw in our income statement, to help finance the firm, but we still keep it on the balance sheet. So with all of this, this ends up being stockholder equity. Total assets equals total liabilities plus stockholder equity. So with this fundamental balance sheet now under our belts, let's take a look at some of these assets and liabilities to get a better understanding of what they mean to the business. First and foremost are your current assets. And there's many different categories, but we like to look at 5 fundamental categories because they pretty much describe all the current assets or items, assets that we expect to bring cash into the business in the near term. The first current asset of note is, well, good old cash. That's the money in your bank account or the money in your pocket. Next is marketable securities. Sometimes firms who have extra cash will put them in, say, a money market mutual fund or some other very liquid account that might give them a little bit of an investment advantage. So marketable securities is the second liquidable asset. And then finally, accounts receivable. Well, I didn't say finally for a reason. I just said it. Third is accounts receivable. And that's the money that is owed to the business by people who have purchased goods and services on credit. Next is inventory. And inventory is an asset, and we expect when we buy inventory for our business that it's going to generate cash as it gets sold to customers. Of course, inventory has some liquidity problems because, well, what if you have obsolete inventory or inventory that was in style last year but now not in style? What do you do with that inventory to generate cash? Inventory is not quite as liquid as inventory is not quite as liquid as accounts receivable, which is not quite as liquid as marketable securities, not quite as liquid as cash. Finally, the fifth category would be prepaid expenses. And an example of prepaid expenses is an insurance policy. It's the most common example used. Quite often businesses will pay their business insurance far in advance. Say 1 year. I worked with a business once. They had to pay their business liability policy 1 full year in advance. That was $20,000, by the way. Now let's say about halfway through the year they need $10,000. They can cancel that liability insurance policy if they want to take the risk on their own shoulders, and that prepaid expense will be refunded to them as you know, in this case would be $10,000. So that's a source of cash if you need it. Generally not advisable because of the risk aspects. Current assets. On the liability side, we have current liabilities. And those include accounts payable. You got to pay your vendors. You got to pay the people that provide you. And quite often you'll have set up through some term of trade a credit account with your supplier. I know in my small business I try to use a credit account with suppliers as much as I can because that delays my payments out while I also try to accelerate my payments in. Accounts payable, then notes payable, and this would be short-term loans, loans say of 3 months length, 6 months length, which quite often businesses will acquire in order to get their inventory purchased. And finally, accrued expenses. Such things as wages due, a salary due, and other such expenses that you have to pay eventually, but you don't have to pay right now, and so they accrue as something you have to pay. So that's our current assets and liabilities. Now, with the balance sheet, we are able to take these elements and convert it into some useful measures of the health of the business. And one of those measures will be net worth. What is that business worth to, well, the common stockholder? So, we take our total assets and we subtract the total liabilities. What the company is worth less what the company owes, and then we also subtract the preferred stockholders' share value, and that will give us the net worth to the common stockholder. The net worth to the common stockholder. This also gets used to compute book value, or how much is each share of that stock really worth. So book value then is equal to net worth to common divided by the number of shares. Now you can see this value presented in many of the companies that you're putting into your portfolio. Go to the value line. If it's working, the library tells me it's working again. Go to value line, and one of the data entries in the information will be the book value. You'll also note that the book value is not even close to the market value of a share, but it does measure what this is worth. If we could immediately liquidate all the assets, pay all the liabilities, and satisfy the preferred stockholders with their share value, that's how much the common stockholder would get. It can represent sort of a measure of the bankruptcy value of the firm to the common stockholder, but certainly not the market value. So, this is just a very quick picture of the balance sheet. I hope it helps clarify some of the things, but it's a very important statement, and many of the detailed elements get used in financial analysis to determine the overall health of the firm. Thanks.